Hello there, and welcome again to as we continue our on the episodes on a series on introduction to accounting. So today we're going to talk about the basic accounting principles. The basic accounting principles. As usual, you are with me, Goodson Charlie, your online tutor. Now that we have looked at the double entry accounting system, we need now to look at the general accounting principles that guide accountants in their preparation of the various financial reports. So the general accounting principles are simply a set of common guidelines, rules, formerly known as the generally accepted accounting principles, GAAP. You must have come across this term. So these are used to prepare consistent, transparent, and reliable financial statements. In the US, the GAAP, the General Accepted Accounting Principles, is the benchmark for financial reporting. So this is developed and maintained primarily by the Financial Accounting Standards Board. That's what we know normally. So we have in the UK we have the International Financial Accounting Standards Board, which form the reporting standards for all the accountants. Now these principles are the basis for the formations of those standards. But at this point, we're not interested in looking at the accounting standard, but rather the key or the basic accounting principles. So the main purpose of these principles is to ensure that the financial records are comparable across the different organizations and over time within the same organizations, providing a clear and fair view of the company's financial health to investors, lenders, and regulators, which are our primary users of the accounting information, as we have already looked at in lesson 2. So what are some of the key core accounting principles? I'll try to be as quick as possible. I've summarized these accounting principles with examples so that you should have a clear understanding within the limited time that I have in recording this particular video. Okay, now let's go to the first one. So the first core accounting principle is what is known as the accrual principle, a very important principle in accounting. Once you understand this, you have no problems in excelling at a higher level in accounting. So the accrual principle dictates that transactions are recorded when they occur, regardless of when the cash is exchanged. So this method provides a more accurate view of company's performance during a specific period of time. I'll give you an example where you have a landscaping company completes a $500 job in March, but doesn't receive a payment from the client until April. So under this principle, what we need to do is the company needs to record the revenue in March when the job was completed, when the work was done and the revenue was earned in March, and the entry in April is just a conversion of an account receivable into cash. So since the job was completed in March, we're going to record to have made a sale in March, regardless of whether we have received the payment for it or not. So that's what basically this principle is all about. You can give more examples and more examples, but that's what actually it is saying. And the next accounting principle Another one important is the matching principle. So this ensures that expenses are recognized in the same period as the revenue they help to generate are recorded. So it ties costs directly to the benefits they produced. If you incur costs today, so let's go to an example. For example, we have a retailer business purchases 100 units of a product for $10 each in November. So the total cost for those products was maybe 1,000 US dollars. That was in November. But in December, they sell 30 pieces of those units for $20 each. So in December's financial statements, the retailer has to record 600 US dollars in revenue. That's the price, the value of those units that we have sold. So it's 30 by $20, giving us a revenue of 600 units. Similarly, for the expenses, we're going to record 300 US dollars in cost of goods sold. So where are we coming? Where do we get these 300 units from? So we're simply multiplying the cost of the goods that we have sold. In this case, we have sold only 30 units. And we're going to record only cost for the goods that we have sold. So the remaining 700 of inventory cost is still an asset. It's our inventory that we have held on our hand and until the remaining units are sold in a later period. Likewise, if we sell 2 units in the next month, we only record costs and expenses related to only the 2 units that we have sold. So that's what this matching principle dictates us to do. And then we have the famous historical cost principle. So this one requires assets to be recorded on the balance sheet at their original purchase price, not their current market value. So this approach prioritizes reliability and objectivity in financial reporting. Let's go straight to our example. So for example, a company buys a piece of land in 2010 for 100,000 US dollars. We know land appreciates with time. So by 2024, the market value of the land has increased to 300 US dollars, 300,000 US dollars. Sorry, excuse me. So in its accounting records, the company continues to list the land as an asset valued at 100,000 US dollars, its historical cost. That's what this principle requires to do. So unless you are selling the land, you want to realize the amount, that's when now maybe we are going to recognize the real value and the whatever profit you have made from there. But we're not interested in that. We're just stating the basic principle as it is. The next principle is the conservatism principle. So this principle requires accountants to have to choose between different. So when accountants have to choose between different accounting methods or estimates, they should select the one that is least likely to overstate assets or income. So this practice anticipates potential losses, but recognizes gains only when they are certain or realized. So this is typically being conservative. We are being realistic with our recording. So for example, a business is facing a lawsuit. The lawyers estimate that there is high probability the company will have to pay 50,000 in damages. So the company should record this as a liability and as an expense immediately. However, if the business is the plaintiff in a lawsuit and expects to win 50,000, it will not record this potential gain until settlement is actually awarded and the cash is received. So you can see that between the damages and the win in a lawsuit, the one that is likely to happen here is the loss. That's why we are recognizing the 50,000 loss. Now that marks the end of lesson 5, part 1. I had to split this presentation into 2 parts due to a limit of time. So thank you for listening. Watch out for the part 2 of the same lesson 5, where we continue to look at some other basic accounting principles. So see you next time. If you have any questions, don't forget to comment and subscribe. Thank you so much.